Well, good evening and welcome to this live stream event on the 5th of April 2022. Martin North from Digital Finance Analytics here. Great to have you on board. And today, of course, we are going to cover off the latest household stress update, which includes some of the mapping analysis and some of the other things that I've been doing. And it's a really quite interesting time looking at all the various data. As always with these shows, what we'll do is just quickly tell you that we're going to do a bit about the house rules and our models, some key slides, Q&A, and then we'll sign off. About an hour and a half as normal. Plenty of time for questions. I've got the postcode engine on as well tonight. And just remind you, of course, we don't provide financial or legal advice on the channel. Play nice in the chat room, please. We do moderate the stream. As at the 5th of April 2022, if you're watching in replay. If you want to get my attention, use at Walk the World. And that means that your question will come into my queue and I can then see it and hopefully answer it. I will say during the first part of the show, I won't be looking at the questions in any great detail. I will be focusing on the presentation. So hold your questions for when I announce that questions are open. But I do encourage you to share other thoughts and comments. Meantime, I've also enabled Super Chat, so if you'd like to make a contribution to the show or indeed get your questions up on the list, you can use Super Chat to do that. And just while we're talking, of course, the way that this all works is that I have my core market model. The core market model includes our surveys, so I'm updating that information tonight to the end of March. It's weekly data, quite current. I also slice and dice the data, so we can look at some of that later. And the core market model allows us also to look at some of the scenarios. I've made some changes to my scenarios, given the trajectory of interest rates, so we'll talk about that. And also, of course, we can take the stress, the trajectory of prices, the buying and selling intentions, the migration data, the economic data, the CPI, wages, employment, all that stuff, bring it through the core market model. And that allows us then to form an opinion down at the postcode level. And I have my postcode engine, which means that if you want to talk about a particular postcode, we can do that. And also, if you want to have a more detailed conversation around a particular suburb, I still run the DFA 1-to-1 sessions. It's an individual confidential discussion. I don't give financial advice, but I can talk about the data and some of the underlying trends. I can look at the stress, home price trend data, and perhaps thoughts about where prices may go based on our modelling. You can also book a time for that, about an hour's conversation, either by phone or by Zoom. There is a cost involved, and it's payable in advance. And if you're interested, you can contact me via my blog. The links are below. It takes about 3 to 5 weeks to book ahead because I've got quite a lot on. And it takes time to do the research, so that's just there if you're interested. Now, let's get on to some really important conversations. The first thing to talk about today is the RBA statement. Of course, it's the first Tuesday in the month, so the RBA came out with its normal statement. I have to say that whilst superficially there wasn't much here that was different, there were a few important changes, so we'll just go through it. Just in terms of the main points. The first one was they're going to maintain the cash rate. No surprise there, of course. They also made the point that inflation has increased sharply around the world. They talked about supply-side problems, Ukraine, etc., and in response, bond yields have risen, and the expectations for future policy interest rates have increased. So that's an interesting comment in terms of the RBA recognising interest rate policies are now under pressure. They said the economy of Australia is still resilient, etc., etc. At the same time, rising prices are putting pressure on household budgets, and the floods are causing hardship for many communities, both of which are very true. Communities, of course, in difficulty are in our thoughts this evening. The strength of the Australian economy is evident in the labour market, unemployment rate falling to 4%, but as I've discussed, of course, previously, that 4% number is a little bit artificial insofar that it doesn't tell you about the underemployment, and there are also a number of issues to do with the overseas workers gone away and no migration, which helps to make employment very much lower than previously. So it's a little bit half-hearted in terms of celebration at 4% in my view. There are some reasons why the numbers are so low. At the same time, it's also interesting that they talk about the unemployment rate falling to 4% in February, and underemployment is its lowest level for many years. Yeah. Well, vacancies are very high, job ads are very high, and they're looking for unemployment rates to fall below 4% this year and to remain below 4% over the next year. Okay, fair enough. Good luck with that. Wages growth has picked up, but at the aggregate level, only the relatively low rates prevailing before the pandemic. This pickup in future rates is only gradual, and there is uncertainty about the behaviour of the labour costs at historically low levels of unemployment. So they are watching the unemployment situation quite closely. And it's interesting, they're talking about aggregate wages growth. That's now back to a more standard approach to monitoring wages growth. Last month, they sort of skirted around it a bit. Then they also went on to say that inflation's increased 2.6%, and headline terms it's 3.5%. That's higher, of course, than the 2 to 3% target. Higher prices for petrol and other commodities will result in further uplifts in inflation. And there's going to be an updated set of forecasts to be published in May. Watch this space. May, of course, potentially after the election. Main sources of uncertainty relate to the speed of resolution of the various supply-side issues, which, of course, just highlight the point about can you cure supply-side inflation with interest rate rises? Well, that will something we might discuss a bit later, because that's quite an interesting question in my mind. Financial conditions in Australia are highly accommodative with low rates. The fixed mortgage rates are down in volume but up in rate, and the exchange rate is quite strong, and the trade weighted index is pretty good too. They talk about, of course, the adequate buffers, but here's the really interesting thing. They are waiting to see actual evidence that inflation is sustained between 2 and 3% before it increases rates. Oh yeah. Inflation has picked up and further increases are expected, but the growth in labour costs have been below rates, likely to be consistent with inflation being sustainably at target. And they say, this is the change. Over coming months, important additional information and evidence will be available to the board on both inflation and the evolution of labour costs. The board will assess this and other incoming information that sets policy to support full employment in Australia and inflation outcomes consistent with the target. So, what's missing from this picture? What's missing is the patient. So up till now, the RBA has said we are happy to remain patient and see how. Now they're talking about more data coming through and assessing it. So this is a significantly more hawkish statement in my view. And I know that originally today, a lot of the analysts didn't pick it up, but I think it's very consistent. And I think it's important to understand the RBA is again signalling higher rates sooner. And there's been a progression over the last 6 months from Phil Lowe, effectively every time moving us closer and closer and closer to seeing rates rise. So that's a very important conclusion from the statement, I think, today. We'll get more details in a couple of weeks, of course, and perhaps they'll share more information then. Now, just in terms of other factors that came out today, the consumer confidence increased by 2.5%, whoopee, but that, of course, is off the back of a 30% decline. This is from Roy Morgan. And what that means is that we are still very much in negative territory. And they say, despite the confidence, it's still 14.3 points below the same time last year. So confidence is still very low. And that's important because confidence is going to actually determine to what extent households spend or not. Very significant factor. And then the other factor is that inflation expectations moved back slightly, but it's still at 5.8%, so it's all about how you interpret this. 0.6 percentage points is lower slightly, and the assumption that Roy Morgan made was that this was to do with the sentiment because of the relief in the budget relating to living costs, although of course that's a bit partial, and the fall in petrol prices is due to lagged effects and the drop in oil price. And the excise cuts will also potentially flow through, and that might increase the sentiment ahead. So, you could on one hand say half glass full, well, sentiment's slightly better, but on the other hand, half glass empty says it's still very low. Inflation expectations are way higher than the RBA, 2 to 3%, and now the RBA is signalling higher prices, interest rates ahead sooner. I think that's very significant. Something else that came out today was from the SQM. Property listings continue to rise in March. If you listened to me talking to Edwin yesterday, we already highlighted that. Figures released today by SQM reveal national residential property listings rose in March by 1.8% to reach 218,000 properties, up from 214 in February. Largest rises in Sydney, Melbourne, Hobart. And he's make the point that listings are still lower compared with 12 months ago. Listings are down in some other areas, but we'll see about that. Listings pretty hot. And also, they did make the point that listings over 180 days dropped a bit. Darwin recorded a build-up on old listings, though. And Louis Christopher says, the rise in listings over March will be welcome for home buyers who largely struggled for choice last year. We have shortage of stock in the markets of Brisbane and Adelaide, and those continue to record massive house prices. As a result, going forward, he expects that we'll shortly enter a lacklustre period of activity in the lead-up to the federal election. After that point, there'll be looming interest rate rises to contend with as well. So that gives you a bit of a flavour of how I was thinking about it. Interestingly, news.com posted a post today saying Sydney's real estate boom is officially over, the experts say, and cited various pieces of information as to why that might be the case. It is interesting how there's a bit of a tenor change in terms of a lot of the reporting now, and people are more talking about the boom being over and things easing back, which is probably right. But of course, again, houses versus units are performing quite differently in different states, and different locations within states are performing very differently. So be careful about these generic and general summaries. They are very, very deceiving in terms of what's going on the ground. It's quite different in different locations. And it is interesting. This is the ASX 30-day interbank cash rate futures, and I just want you to look at the sequence down the bottom here, because what this shows you is that this was before the RBA announcement. We were looking at rates of more than 1% by October and 3% by August 23. But if you then look a day later, you can see now that we've got 1.4% by October and 3.3% by September 2023. So what this has done is this has pushed the expectations from a market perspective up. And so everybody now in the market is saying higher interest rates sooner. And that could be 2 or 3% in the next few months. That's a big increase based off very low base rates that we have. And if that's anything like right, and of course that's much more extreme than what the Reserve Bank is actually signalling, but it looks to me as though that's more perhaps in line with what may happen. And remember, of course, that the Federal Reserve will also potentially lift rates further, even 50 basis point rises. And that means that the net effect potentially will be to have rates higher faster than a lot of people are expecting. Expect the unexpected with regard to future interest rates. Now, just a quick reminder before we look at the stress data, that the aggregate data for credit growth was pretty strong, with owner occupation at 8.9, overall housing at 7.8, and investment up 3.9 over the last 12 months. Very strong. So it also begs the question as to whether, in fact, the APRA should be tightening back the lending controls. In that statement that I mentioned earlier on from the Reserve Bank, there was a comment about lending standards need to be kept tight. Well, I can tell you that there's a lot of lending being done that shouldn't be done at the moment, particularly with those higher interest rates ahead. So I do think this is going to come unglued at some point. And this growth in credit is extreme and potentially can lead us up the garden path later, I think. And on that thought, it's also worth noting that the debt-to-income ratio, which I actually discussed today in a post, I'll come back in a second, is higher than it's been. That's now 185. This is the RBA scrambled figure, and so it's not giving a very accurate view. Remember, it's just an average across all households and all debts. The household debt, of course, we're talking about here, so it excludes firms. But interestingly, the housing debt-to-income ratio and the owner-occupied housing debt-to-income ratio, they're all rising. So whatever you may think about the ability to service debts with low interest rates, the debt-to-income ratio is a problem. It's higher than it was back in 2001, or indeed at any time up until quite recently. And just on that, if you want a deeper dive on the analysis and also what the assumptions are that the Reserve Bank makes when it actually talks about these ratios in their monthly or quarterly series. I did a deep dive on household debt and income ratios today, and I took apart all of the various charts and also the underlying assumptions, and that shows that some are seasonally adjusted, some not. Some are including firms and some not. And there's a bunch of assumptions that people don't understand in those numbers. So they are a bit deceptive, but the bottom line is that the debt to income ratio is rising, and that's a problem. Wages growth expectations, of course, remain relatively muted. The budget also showed that, maybe, if we're lucky, wage prices might overtake the CPI later. But at the moment, we're in the situation where real wages are going backwards. And just think about that. We have the situation where we have big debt, where we have interest rates rising, and we have real incomes going backwards. And of course, all the rising costs from the pressures to do with supply chains and all those things as well. So those are the factors that need to be put into the model when we think about what's happening. And by the way, the average loan size for unoccupied dwellings continues to rise. It came back slightly in New South Wales, but actually compared with 12 months ago, the average new loan is a lot bigger. So people are getting leveraged into bigger loans because of the low interest rates. Now, that takes us nicely to the mortgage stress. And so this is to March, and this is based on my analysis. And so the first thing to say is that the mortgage stress is now at 42.2% of households. So that's pretty much as high as it's ever been. So it's an increase from last month. And it's worth just noting the significant move compared with February 2020, when it was 32.9. Now, that's a relevant date because that's pre-COVID. So since COVID has come, and since all of the government stimulus and low interest rates, overall mortgage stress has moved up 10%. That's a big move, and it's still going higher. And that is a concern, as you'll see a bit later. Also, just again, the household debt ratio is 186.2. You can see that's now back up to as high as it's ever been. Remember, that's with the household debt ratio, facing into very low interest rates, but what happens when interest rates rise? That's the key question to ask. Now, these are the stress data sets for March. And let me just remind you again that stress is defined in a very specific way here. It's not a set percentage of income going on the mortgage. Okay. What I look here at is total cash flow, money in, money out. How much money is coming in after tax? How much money is going out on all the various expenditures, including the mortgage or the rent or whatever. And if there is insufficient money to be able to cover all the outgoings without grabbing more credit, then they are classified as in stress. Now, of course, you may have savings, you may have assets that you can convert, but if ultimately you've got a continued situation where every month you're spending more than the income that's coming in, that ultimately is going to spell disaster. And that's what I'm measuring with this particular set of information. So in this set of information, you can see here that overall mortgage stress is now significantly higher than in February. In February, it was 41.59, and in March, it's up to 42.15%. So not a huge rise, but a significant rise. And if you want the numbers, it was 1.524 to 1.539 million households. And I've also just highlighted where the pressure is. So in yellow, these figures are higher than last month. So in the ACT, mortgage stress is higher. New South Wales, it's higher. South Australia, it's higher. Tasmania, it's higher. And Western Australia, it's higher. It's a little down in Victoria, Queensland, the Northern Territories. If I look at rental stress is now at 41.8% of those renting. And again, we've seen growth in stress in Queensland, South Australia, Victoria, Western Australia, 41.81. Investor stress, so these are property investors, and that includes people who are trying to sell their investment property, who've been unable to let it, or who have let it but are not making enough to cover the costs of the investment itself. And about 25% of those investors are in difficulty. And interestingly, the highest proportion is in New South Wales, and also we see Tasmania and Victoria and Western Australia at around 23%. And then finally, financial stress, which is the aggregate measure across all households, and they're at 41% of households, or in financial stress, just over 4 million households out of the 9.5 million. That's quite a big number. And you can see there that New South Wales holds the prize for the proportion in financial stress. Then we have Tasmania. Then we have the likes of Victoria, and we have Western Australia at 38%. So you can see there a significant story in terms of what's going on. We can just take it a bit further by looking across our segments again. And as always, I highlight, of course, young growing families, a lot of first-time buyers there. So a lot of new buyers coming into the market are in financial stress at 60% and in mortgage stress at 75%. So in other words, 3/4 of first-time buyers and young growing families are having cash flow issues. That's gone up again. We also got battling urban disadvantaged fringe households there, sitting in those new high-growth estates. Significant pressures there. And you can see that there's pressure across the board, but those 2 or 3 areas are the ones where it's most significant. Then we go to rental stress, and more mature, stable families and the multicultural establishment, the first-generation Australians, is where the highest degree of rental stress is, plus the young affluents. So a lot of younger people who've got bigger incomes but are having to pay a lot of it out for their rentals, which means that more than half of the young affluents are actually in stress at the moment. And if we go to the investor stress, you can see then we've got quite a lot of movement, young affluents. This is very interesting, of course. I keep calling this out. A lot of young affluents really don't know what they're doing when it comes to their property investors. So they're piling in and getting into difficulty. A lot of exclusive professionals who, again, have lots of property aren't necessarily finding that they're all performing as well as they would like. And we've got a lot of first-generation Australians, bit the same, struggling with their investment properties. And overall financial stress is highest across all those groups of young growing families, the young affluents, and the battling urban. So you can see that this is not just 1 or 2 groups. It's quite widely spread, and it's getting worse, which is not a good look. Now, briefly, what I can then do is just go through the various postcodes. And I won't do this in detail because you can always look at it later if you want more detail. But it gives you a bit of a flavour of the types of areas where the mortgage stress is highest. Now, there's always an interesting question about whether I show this as percentages or whether I show as the count of households in stress. I choose in these shows to show the stressed count because I want to show you where the big numbers are, because the large counts are probably the most significant thing. But, it is, as you'll see as we go down the list, some have a higher or lower percentage, and you could look at the alternative. But, of course, the danger is if you have a very small percentage, a very small number, I should say, with a very high percentage, you might end up with a misleading sort of story in terms of what's precisely gone on. So let's just quickly get down there. Toowoomba in Queensland, 4350, is unfortunately the postcode with the highest count of households in mortgage stress now. That's up in Queensland. We go to Western Australia, to places like Hocking and Tapping, more than 9,000. We then go to Victoria, to Narre Warren South, postcode 3805. Bear that in mind, 3805. You'll see that coming up in another slide in a moment. More than 9,000. Then we've got 3806 next door, Berwick and Harkaway. And then we've got another Victorian postcode, Roxburgh Park, 3064 at more than 7,500. Cranbourne. So you see this great swathe of Victorian high growth, high corridor, high development postcodes. Then we go up to Queensland, to Pine Mountain, down to Western Australia, to places like Quinnslock and Ridgewood and Tamala Park. Then we come back to Victoria, to Sydenham, then to Pakenham, then to regional areas like Ballarat East, then Point Cook and Derrimont, Mount Annan in New South Wales, and then G-Bug in Queensland. So you can see that some really interesting moves compared with last month. Those of you who remember what happened then, it's worth comparing. So more Victorian postcodes in these high growth areas are in difficulty. Do the same for rental stress, and there Victorian postcode 3000, centre of Melbourne, is the postcode with the highest count. That's a lot of course, high-rise development that's gone on close to the city centre in Victoria. And a lot of those rents are sky high and people are still not earning as much as they were. Toowoomba's on the list then. Then we go to New South Wales, to places like Campbelltown in postcode 2560. And then we go to another New South Wales postcode 2540, which includes places like Sussex Inlet and Falls Creek, more than 9,500. Then we go to Mount Druitt and Lethbridge Park, 2770 at 9,300. Another postcode, this is North Gosford and Gosford, of course, in the Central Coast with 9,100. And then we go to Chipping Norton, Liverpool, Mount Pritchard, places like that, 8,900. Then we go to Blacktown, more than 8,000. Then we come back down to Victoria, South Yarra. And then we have a couple of Queensland postcodes, places like Pacific Pines, and we also have Surfers Paradise. So again, the problem there is that the rents are very big and the incomes aren't. Then we go back to Surrey Hills and Darlinghurst in New South Wales and Bondi Beach off the bottom of the chart there. Finally, we can go to the stressed investors, and once again we find that there's some interesting footprints with Queensland in 4670 and also Surfers Paradise with significant numbers of investors struggling. That's a combination of big costs to get into the property market and also rentals under pressure. Melbourne Victorian 3000 with more than 3,700 investors struggling. Another Queensland postcode, Labrador Southport, postcode 4215. Then we have Surrey Hills and Darlinghurst. Then we go to Greystanes and Wentworthville and Westmead with 3,400. Then we go to places like Wagga Wagga, which is interesting, 3650. So we have some investors there struggling. Back to Newtown, postcode 2042, 3,300. And then we go back up to Queensland again, down to South Bank, and on it goes. And just finally, to give you the aggregate view, of course, we can also then look at financial stress. And as you may not be surprised to see, some New South Wales postcode at 2560 and 2170, then Toowoomba, then some Victorian postcodes, including Victoria and 3000, Cranbourne, Derrimut, then some Queensland ones. So you can see it's across a whole bunch of different areas, but you can see the same pattern. High growth corridors, a lot of new developments, a lot of people who've bought relatively recently are struggling. A lot of property investors are still not being able to let those properties to generate significant income and revenue, and the costs of rising in terms of trying to maintain those properties. So there is a big set of issues here. This is a big number, and I don't think it's going to get any easier in the short term. And remember, this is before interest rates really take off. So you would expect to see higher levels of stress as rates rise ahead. Okay, so that's the latest then on the stress story. Now, just before I move on and look at the comments and then show you some of the mapping, let me just make this point. I want to highlight the impact of higher interest rates because it is very significant. And I got this little model here. This is from CBA. At 1.99% on a 30-year mortgage, the overall repayment for $100,000 would be $365 per month. So if you go for 600,000, you multiply it by 6. If you then put that rate up to 3%, you go up to $422 a month per 100,000. That's an increase of 15.6%. And if you go up to 4%, the repayments per month goes up to $478 per month, up 31%. And the point I want to make with these numbers is that the interest rate movement can be quite small, just a few percent, but the impact on the monthly repayments is significant. It's much, much bigger, and that's because, of course, the relative payments that you're making on the interest payments relative to the capital repayments grows up very much more quickly. That's what people don't understand. And so when people talk about, these rate rises 1 or 2%, it's going to be easy to cope with, you should be thinking about the actual increase in the real monthly repayment. Now, of course, the banks will say, well, we can extend the loan for another 5 years or 10 years or something, make it duration or go interest only. But at the end of the day, the mortgage still has to be paid back. So that's why this is a big deal. And in terms of rate sensitivity, this is the latest modelling I've done. So I've taken the model and I said, what happens if rates were to go up 0.5%, 1%, 1.5%, 2%, 3%, 4%, 5%, 6%, 7% today in my model? And remember, we've got 1.4 million households, or 1.5 million, in stress. Well, you can see here that the growth rate is quite significant. And essentially, there's a lot more, another 1.6 million if rates went 7% higher, which is, long-term increase. That might not be such a long way out. But the point is, there are a lot of households who are beginning to get impacted. That's one reason why I think household financial confidence is going to maintain relatively pressurised in the short term. And what I always want to say about this is just a rough indication, because of course there are some feedback loops too. So for example, if in fact we're in the situation where interest rates go up, businesses will invest less. As businesses invest less, they will be less able to pay wages and they might have to dial back hours. So there's a feedback loop there. And so not only will the rate rise hit, but also potentially the hours work might go down as well. And it's some of those feedback loops that the modelling that I do tries to capture as well. All right, so with that, we might just go on and do some of the stress mapping, simply because I do happen to have that information readily available. And the point about the stress mapping is that it helps me show you where the hotspots are visibly. And this is Melbourne first, Melbourne 3000, it's mortgage stress. And you can see here that, remember that 3806 postcode and 3805 postcode that I mentioned earlier on? Well, it's sort of there, right? So that's a big splodge. And that splodge is the high penetration of stress. And you can see how it circulates around the high growth corridors, Point Cook, Derrimont around here, down towards Dandenong here and Frankston, places like that, and then out in Ballarat. And if you drill in, you can sort of begin to get a bit of a feel for precisely where those footprints are. Some of the areas north of the city are also feeling it, places around here as well. Closer in, mortgage stress is less of a problem. And in some of those inner suburban areas, again, it's not anything like as severe. But the point is, the big numbers are in those more extreme colours, and that's a problem. Now, if I then go to Sydney, and we just start in Sydney, postcode 2000, and just pull out a little bit, you can begin to see that once again we have little hotspots. And if you remember what the maps looked like last month, they're not dramatically different. But what is true is that the numbers are just a little bit higher, and you start then seeing some of those Western Sydney suburbs like Liverpool come in. That's where there's a big hotspot. And as you pull out further, you can see that some of those northwest regions around Blacktown are also there, and Campbelltown. So there are some of the really big hotspots for mortgage stress. Pull out a bit further, you can see that this is a relatively consistent pattern. And so you've got the western suburbs and the western Sydney. Closer to the city, things are quite a lot better. But again, there are a few hotspots with a few, but it's western Sydney where a lot of the problems are. Maybe not surprising, but it is actually quite worrying to see it continuing to grow. And actually, before I just do that, let me just pull out slightly further. I just want to make one other point. If we go slightly further out, I can just begin to show you that over the dividing range, places like Orange are also feeling it too. So it isn't just the areas around Sydney, but there are regional centres too that are also feeling the pain as well. What we might do is just go to Brisbane. And, the story in Brisbane is not as extreme as you perhaps might expect, although prices have now accelerated considerably, and the latest debt ratios that are actually being displayed there are very significant. But you can see already some hot spots like Camp Hill, for example, 4152, places like that are beginning to show it. And as you pull out, you can see that Ipswich is on the radar as well. And there are, again, some regional suburbs, as well as those in and around Brisbane, where the relative numbers are quite a lot higher. And of course, the absolute counts relative to other parts of the country will be a bit lower because of the population footprint. But nevertheless, there are some significant pressure points here. And if you go down into places like the Gold Coast, again, not the same high counts as some, but those are still quite significant counts. But this Ipswich area in particular is one that concerns me greatly at the moment. And if I then go to Hobart, just to highlight the point that, again, the total numbers are quite a lot lower because the population base is a lot lower. But Hobart is also a place where there are considerable housing pressures. The prices have risen dramatically. The demand for rental accommodation is extremely high as well. And this is putting a lot of pressure on households. So you can see that there are areas around Hobart that are actually beginning to be quite concerning as well. And I might just do one more. Now, the point I want to make about all of these mappings is it shows you how diverse the mortgage stress is, and it's not uniformly spread in any way whatsoever. It really does depend on where you look and what you see. And we could do the same. I won't necessarily do it now because we're running quite short on time, but I can do it also for rental as well as for mortgage stress and for the investor stress as well. Story in Perth, it's not too bad in and around the centre, but if you go north and south of the city, some of those new high growth areas, particularly up around here, definitely a problem. And once again, the same old. There are some suburbs where there's a lot of issues. So, in summary, then, you can see that the patchwork quilt of mortgage stress continues to develop. As it evolves, we see quite considerable differences in terms of what we find. And frankly, I think the story is one of continued pressure on households over the next few weeks and months. Okay, let me have a look at some of the chat and see what conversations have been going on and if there are specific questions. Jeff makes the point, and he's quite right, that Ipswich covers a very large area. It absolutely does. But within Ipswich, there are a lot of high growth areas, and it's those high growth corridors that are really the problem. What I would say is that, I see this again and again and again, within those larger postcodes, there's been a lot of new development, and it's a lot of relative new development where a lot of the issues actually are. And yeah, you can overlay stress map with crime map. I've done that before, and I've definitely noticed some very interesting correlations. And of course, things like crime and also some of the social issues that follow are all connected, unfortunately. Another interesting comment there about get somebody from insolvency on the show to show some statistics. Yeah, it's hard to get real good insolvency data because, of course, what happens is the banks tend to pressurize people to sell and get out rather than they actually end up defaulting. So defaults will remain low for a long, long time because the banks are very active in terms of persuading people, if they've got issues, to be able to actually handle those by sell now because the property prices are relatively high. And one of the reasons why listings are up is because there are more people being persuaded to sell and to get out while they can. One quick look up the comments. Anything specific? No? Good. Okay, I think I'm probably up to date. Yes. I do have my scenarios today. We'll go through them in just a moment or two. Cookie Boy says RBA is playing with fire by delaying rate rise, especially overseas countries are raising rates. Yeah, that's the point really. So the RBA will continue to say, well, we don't want to raise the rates. The point is they know the amount of debt that's in the system. They know the implications if in fact rates are raised. So the real challenge is how far can they raise them? How quickly should they raise them? And like I say from earlier on, every time I listen to those minutes, they keep bringing the date further forward. So again, more hawkish today. And it'll be interesting to see what the press coverage is overnight and tomorrow when people are talking about what the Reserve Bank said. I read it as they know that they've got to put rates up. And they'll wait till after the election, of course, because they can't put rates up through the election. That would be politically quite challenging. But they probably should have done it a long time before. And the problem is the longer you leave it, the more it is that you've got to put rates up to try and hold it. But remember this, I keep coming back to this point. We are dealing with supply-side shocks that are generating inflation. It's not the standard wage-led inflation. And the question I've got, and I keep coming back to, is when you put interest rates up, you dampen demand, sure. But do you actually deal with supply chain shocks in any way whatsoever? Or do you simply add another bunch of pressures on top? And that'll be the really interesting question, which is why I still think that we'll see the Fed lift rates and then have to bring them back down later. And I'm still, in my scenarios, there is a scenario that says the Reserve Bank will have to take rates lower again. So we'll see how that goes over that 2 to 3 year horizon. So it's certainly not very clear as to how this may play out. Jeff makes the point that Ipswich houses sell very quickly and they've risen in price a lot. I agree that the prices are higher and they are quite a few of them sell. Not so apartments or units, of course, they are much more hanging fire. But also, if you look at the prices, I'm not sure whether the momentum is as strong as it was. In fact, next week I've got Megan Wells coming on, who is an expert in Brisbane property, because I want to talk to her about Brisbane property. So we might pick up that next week, Jeff, and talk with her specifically about some of those outer-lying regions and what's going on. And the Cookie Boy says, isn't it amazing that people go out borrowing $1 million plus, but fuel prices go up by $30, $40 a week, and it's the end of the world. Yeah, it is an interesting phenomenon. Of course, remember this, Cookie Boy, the problem is that a lot of people take the banks on their face value. When they say, yeah, sure, you can afford it, they basically assume that the bank says, well, if I can afford it, then I can afford it. The trouble is the banks are using a very specific set of measures in terms of costs and ratios and things, which means that quite often what actually you can afford isn't the same as what you can afford. And that's what I see in my stress data. So quite often what I see is that households who thought they were able to handle significantly larger mortgages find they can't because their income has not grown. Their costs are driving up very significantly, childcare costs, food costs, as well as the fuel costs. And by the way, the 22 cents isn't enough to offset all of the rise in prices over the last 6 months in fuel, of course. And the other point I want to make is that this inflationary trend was in play before the Ukraine invasion and before there was significant talk from the Fed of lifting rates. So this is not like it's all a sudden shock, but it's interesting how a lot of politicians are spinning it, and I think central banks will too, that this is all created by the Ukraine situation and the need to respond to that. No, this was wired into the way the economy was going earlier. This is 6, 12, maybe even 3 or maybe even 10 years in the making. Remember that I trace back some of the mistakes that were made post the global financial crisis to explain why we're in the crisis we're in now. They cut rates too low, they supported the markets, they threw liquidity in, and they kept doing it and kept doing it and kept doing it. And remember, quantitative easing is still alive and well. Whatever you might think, both in the US and in Australia, quantitative easing is still there. The RBA is still injecting more liquidity into the system, even now. Okay, what else have we got? Another interesting comment from Cookie Boy. We'll put that one up. Thank you. Yeah. In Southeast Queensland listings drops since the floods. Yeah, the floods is a very interesting question, and it's hard for me to get good data, of course, in some of those areas because of the floods, but they're quite localised areas. But I will try and get some better reads later. Again, Megan may have some views too. But what I do find is that one of the things that I often talk about in my one-to-ones is floodplains and buying in low-lying areas. And the number of times I find people haven't even thought about it. Well, more people are now thinking about it. So that suggests that if you've got a property in a floodplain, you're going to have to answer a lot more questions than previously as to whether it's actually going to get washed away or anything like that. So I think that's a significant, interesting thing. Stripy Cat says, and the taxes on investment properties and rental income. Indeed, yeah, there's a lot of issues that people don't understand. When they think about cash flow, money in, money out on their investment property, some investors say, look, I don't care if I don't make any money on the cash flow because I'm going to get capital gains, capital appreciation. And you might, or you might not. Prices have moved up quite strongly in some areas. If you were looking at houses, less so for apartments in sort of areas of Sydney, for example. North Ryde high-rise apartments, as I showed in one of my posts recently, are down significantly from where they were in 2017. So it is not actually quite as simple as saying, as long as I hold it long enough, I'm going to make money. Not necessarily true. Many investors have no idea what returns they're getting, if any. And that's a big deal, because the fact of the matter is that a lot of investors just assume that they're always going to make money, and they just assume that, well, I'm making a loss for a year or two and I'm offset against tax, so that's okay, because capital appreciation will build for me. I think that high-rise particularly will not necessarily follow that mode of operation. We'll see. And Jeff made the point, I live in Ipswich, prefer it more than Melbourne 3167, where I was a year ago. Yeah, well, there are some nice areas in and around Ipswich. There are also some significant high growth corridors that are probably a little less salubrious. Cookie Boy says, how many Victorians have moved to Queensland during COVID regretting that decision? Yes, I'm seeing that in my surveys, Cookie Boy. There's half 50,000 or so households have moved up. About half of those in my surveys are now regretting that move. Two reasons. One is the floods and everything, and the other is that, of course, now Melbourne is looking a little bit more attractive because the COVID lockdowns are past. We're going to see how many reverse course and what that does to prices later. Okay, what we might do then is just move on and talk briefly about my scenarios. Now, as I always say with my scenarios, the scenarios are just a way of exploring the different futures and looking at the consequences, not forecasts. It does move around a lot. Scenarios are based on what we see today and running forward over the next 2 to 3 years. And the bottom line is this, that there are various ways this could play out, and what I tried to do is capture some of those in my scenarios. Now, I've made some changes. So the RBA baseline is now, over the next 24 to 36 months, baseline from now, is the RBA rate at about 1.5%. That is where I think the RBA is thinking. Unemployment 4 or a bit below. The mortgage rate would translate, and I've now started including a mortgage rate in this set of scenarios, about 3.5% on average. Mortgage stress about 38%, and I reckon there's a little bit of move on house price, a little bit of a slide, maybe some slide upside of homes on standalone blocks. And effectively we see some rate rises over the next couple of years and the end of quantitative easing. I give that about a 10% probability. On my base case, this is the one that I think is the most likely at the moment. I'm thinking that the Reserve Bank rate, cash rate, will be perhaps 3% over the next 2 to 3 years. So that really is a bit below where the markets are, but not dramatically so. I think they'll be forced to do it. I think as a result of that, the unemployment rate will be higher, 4.8. Still quite low, but it's still higher than it is today. Mortgage rate will translate to maybe 5, maybe 5.5%. Mortgage stress will be higher, but 45%. The losses would be higher. And the downside would be 25% down on properties. Again, that some will continue to move up, particularly houses. We will see lots of extra incentive to try and pull people into the markets, particularly after the election. More first-time buyer incentives, bribes, whatever you want to call them, all that sort of stuff. And I think there's about a 50% probability of that actually playing out. Then we've got to think about the longer-term crunch. So what happens if, in fact, things don't go and we get higher unemployment, and as a result of that, the inflation dissipates, and in that case, the RBA might be forced to take rates lower, close towards zero. That would give us a lower mortgage rate. The mortgage stress would perhaps be about 40%. And even so, I think we'd probably see some falls in prices, 25% scenario there. And then the other one is what I call the multi-wave disruption. So that's things like the conflicts continue to escalate and some of the broader issues. And look, if things went really badly pear-shaped, we might actually sort of be seeing much higher unemployment and very low mortgage rates and high levels of falls. I think this is pretty unlikely, but I've put it at 15% at the moment because there are so many uncertainties. But if you wanted my best view, and in my models I use the first three, by the way, I think this best case scenario is probably reasonable. So there is still a path for some further increases, but also the downside is quite strong, and I think we're going to see more downside going ahead. The fact of the matter is that the momentum is going to ease as the interest rates rise. We know that listings are also quite a lot higher now than previously, and all of those things together play into my scenarios. Thank you, Stripey Cat, for your super chat. Really appreciate it. Smooth Operator asks this question. Will the collapse of the Chinese market affect our market, creating another collapse? And if so, how big? At the moment, the property sector in China is definitely continuing to wobble. I made a show on that the other day. But what I'm seeing is still very strong demand for commodities. And of course, that means that the trade balance with Australia is looking quite well. And in fact, they're looking as though they could take some of the tariffs off. So I'm not sure necessarily that China will actually wilt, because they're talking now about extra stimulus and more programs to try and actually keep the 5.5% target growth rate in China up. Now, it'll be interesting to see whether they are successful in doing that, but at the moment, I don't think the negative draft from China is as strong as it was some little while ago. But watch the property sector, because if the property sector really blows up, as it still could, maybe all bets are off. But at the moment, they are importing a lot of iron ore and a lot of coal and a lot of our other products too. So, and of course, we are also looking for other markets now, including the India trade agreement that was announced recently. Cookie Boy says the latest China lockdowns and new COVID variants will cause more supply chain issues. Yeah, absolutely, they will. Yeah, we're already seeing it. And interestingly, I was talking to somebody in the building trade today who actually has now got no supply of some particular things that they need from China. They can't get an ETA. And effectively that particular project is now on ice because they're halfway through it and we're waiting for delivery of these particular components. And so they're stuck. And I'm hearing more and more stories of builders not able to get the parts and not able to finish projects. And of course that all just rolls on there in terms of more costs. Interesting question here about, can RBA cut rates to abate falling property prices if the US Fed is still hiking? That's a really big question. In theory, Phil Lowe will say he's not looking at what the Fed is doing, he's looking at what he's doing locally. But in practice, those international financial markets are so all connected. If the Fed lifts rates dramatically, and they're talking significant rises over the next few months, then the bottom line is that the RBA will be forced probably to follow suit. If they don't, the exchange rate will be significantly impacted. Now, of course, it's quite strong at the moment, the exchange rate, and there is some latitude to let it come back a little bit. But I don't think the Fed's moves will be completely disconnected from what we do here. And by the way, if the Eurozone and the UK and other countries also lift rates too, that's going to put upward pressure. And the financial markets ultimately, as I showed you earlier on, are calling for significant rate rises. I don't think the Fed will not lift, and I don't think the RBA will be able to resist. Eventually they will capitulate. It's a question of how quickly and to what trajectory. And that's the big question, because they are very sensitive to rate rises because they know the impact on the debt that many people are sitting on. They don't deny that there are some people who are exposed, but of course they say most people are fine. I'm afraid that my analysis suggests that there is about 30% of people who are doing absolutely fine and they'll be able to handle significant rate rises. But that leaves a 70% of households who are in some difficulty, of which about half of those are severely in difficulty and will be finding it very difficult, even if rates move just up a bit, get a loan 2 or 3%. And Cookie Boy adds the comment, commodity price tank, Aussie will tank too. Absolutely. Yeah, the commodity prices is where a lot of it's at. Of course, we've been quite lucky because oil prices are high, and that's actually supported some of our big oil producers, and that's pretty strong. And BHP and those people are actually doing quite well too. So at the moment, one reason why our stock market is performing very strongly is because of the commodity connection. And of course, we are seen internationally as a safe bet when it comes to the commodity cycle. So, yeah, if that keeps going, then we may see some more upside. But the other side of it is if it turns turtle, all bets are off. Interesting comment there. Will the Indian free trade agreement make it harder for local manufacturing as competing with India now is on the free market? Yeah, it will, because it's removed some of the trade tariff. Now, it's not all going off immediately. My understanding is it's going to morph and take some time, but absolutely. So that I'm quite sceptical of these trade agreements. It seems to me that they are very good political theatre, but economically, I'm not as convinced that it really actually has the great effects that people claim. It's funny how they very rarely do post audits, and so we'll see what happens. But yeah, it does reduce effectively barriers, and sometimes that means that jobs go offshore and cheaper imports come in from elsewhere. And frankly, what I've said several times is we need to have a stronger manufacturing base here in Australia. We need to make stuff locally. That's got to be the future of our economy, rather than just chucking raw materials overseas and letting other people make it cheaper and then selling it back to us expensive. That's a really crazy short-term way of doing things, in my view. Okay, now where do I go next? Let me just go back to my slides. We've already started into the Q&A. Now what I will just do is pull up the postcode engine, because of course I do have the postcode engine up there as well. And just so you understand how this works, I have data for every postcode in the country, well, pretty much every postcode. And so for postcode 2000, for example, I can tell you that there are 13,800 households, there are 1,700 borrowing, 10,800 renting. There's 74% of households in that postcode in financial stress, of which 33% are in mortgage stress, 65% are in rental stress, 75% are investor stress, so the investors are really finding it pretty tough at the moment. And then I've also got some projections in terms of what prices may do in our bearish, bullish and neutral case. And over the next 3 years, I'm saying there's not much happening. There may be a slight rise. Worst case, a fall for houses of maybe 16%, not that many houses, mostly apartments now. Of course, units though, falls of perhaps 12%, or about bullish case of 1.3%. Now, all of this information for every postcode is accessible via our portal. And so if you want more information about a particular postcode, then you can sign up via Patreon and get access to the portal, which gives you all of the information that we actually have for that particular postcode. It's updated every month, and so you can see the trends over time. And the portal that we provide allows people to compare different postcodes. It allows you to look at projections. It allows you to look at some of the trend information as well. So it's actually quite powerful. And I see that we've got a few requests now for postcodes. 3350. Well, let's try that one and see what that tells you, shall we? 3350. Put it up. Okay, 3350. Get rid of that. So we're talking here about Ballarat. 26,700 households, 9,600 borrowing, 12,300 renting, about 9,400 properties for rent, 48% in financial stress. So generally, anything above about 40% is above the national average rule of thumb. And within that, so this is an aggregate, the financial stress, and if you drop down into the mild stress, 6,700. So for a lot of people under financial pressure with mortgages, that's 70% of households in the postcode. 70%, that's a big number. We're looking at perhaps a 3% default rate over the next year or so. Rental stress at the 38%, and overall investors at 28%. So this is a story about mortgage stress predominantly. A lot of people finding that their mortgages are a real pain, the cost of living are rising, incomes are not. And in terms of projections, the projections for houses, this is just my modelling. The bullish case, we might see a 4% rise over the next 3 years. The bearish case, we might see a fall of about 14% over the next 3 years. For units, a rise of 3% over 3 years, or a fall of about 10% is my modelling. And, you know, depending on what assumptions you make, it might change, but that gives you a bit of a flavour of what it might look like. Okay, let's have a look. Nigel wanted 3212. Let's see if I can put that one up. Avalon. Oh, 3212. No, 3212. I actually misread that. Sorry. This is Lyra. Places like that. Okay, 3212 Victoria. Yep, 3212. Okay, 5,900 households, so a small account. 3,200 borrowing. 1,900 renting. 1,400 for rent. 35% in financial stress. 12% in mortgage stress, that's a pretty low number. Rental stress is the issue there. 69% of those renting are having difficulty, and 23% are actually investors who are stressed. So this is a story about rental stress, and that's partly because of the urban fringe, and there are some younger people involved there as well, so in our young affluent group. In terms of modelling, 5.5% bullish case over 3 years for houses, or a fall of 12%. For units, 4% over 3 years, bullish, and bearish, down about 9%. Samuel, let's put that one up. Whoops. 4006. Try and put that one in for you. The likes of Newstead, Fortitude Valley. Used to work there years ago. Okay, 8,800 households, 1,100 borrowing, 7,100 renting, and there's about 5,500 properties for rent. 69% in financial stress. Of that, mortgage stress is pretty low at 27%, just 352. The rental stress at 3,929 is 55%, so again it's a rental stress problem. And the corollary of that is the investors that are also quite stressed as well at 73%. So that's the sort of the story. And in terms of projections ahead, we're sort of, for houses, looking at over the next 3 years, maybe 5 to 6% on the bullish, or down 12%. And for units, bullish at 4, bearish at 9, based on what I'm seeing at the moment. Now, I know that people are saying, well, hang on, the Melbourne is definitely off, but what about Brisbane? Isn't that firing on all cylinders? Well, maybe it is at the minute, but I'm looking over 2 or 3 years. Remember, this is looking ahead rather than actually over the next 6 months or so. So that's just gives you a time frame of which I'm looking at it. And as with all of these things, it'll change, but it just gives you a bit of flavour. And this is based off what I'm seeing from the model at the moment. Okay, what else have we got? Yeah, might just remind everybody to please like the post if you haven't done so yet, and do subscribe as well. I will be trying to encourage people to subscribe. It's interesting that YouTube has been pruning off old subscribers who were not real subscribers. A lot of people years ago probably subscribed, and then they sort of subscribed predominantly to send silly messages about crypto. So YouTube's been pruning those, so my subscriber base has been pretty static over the last few months because I'm getting new subscribers coming in, but they also prune some of the old ones away. So please like, and also if you haven't subscribed, please subscribe to get notification for what we do. And if you want to ring that bell, you also get notification every time I post. Okay, Death and Regret says 4270. Let me do that. 4270. Tambourine. Okay, there we go. I'll just get rid of that so you can see it. 1,300 households, 980 borrowing, 359 renting, 47% in financial stress, 67% in mortgage stress, so that's quite a high number. Anything above 40, as I've said before, is definitely significant. Rental stress and investor stress doesn't really register, so this is a mortgage stress story significantly. Price changes, over 3 years, 9% bullish, down 9% bearish for houses, or 6% up for units, or down 6% bearish is what I'm seeing at the moment. And we'll go on from there and see what else we have. Just want to say thanks to Nigel for that. Glad to help, Nigel, and thanks very much for the super chat. It's greatly appreciated. Chipper makes an interesting point. Even if house prices stay the same, inflation is rising, so will be like a loss. Yes, and of course the other factor is, of course, with the quantitative easing, the quantity of money in circulation is going up, right? So you could think of house price inflation not as prices going up, but as the number of dollars needed going up because of the inflationary pressures. Inflation in the economy through quantitative easing is probably a lot bigger, a lot more significant than many people actually figure. And that's one of the reasons why this whole discussion about income growth is so significant, because so many people are getting squeezed because their income is in real terms going backwards. And it's partly because all this extra money that's been created through this quantitative easing program in Australia, in the UK, in the US and other countries around the world. How we unwind from this is, of course, the interesting question. And remember this also, when rates go up, the cost of debt rises. So the cost of government debt goes up, which means you've got to actually spend more servicing the debt, but also the costs of debt to corporates goes up. So their strategies of buying back their shares on very cheap loans and bonds goes away. That means they can't actually make their business perform, and they've got to actually service higher debts. And so this whole thing can come unglued quite quickly. And one of the things that is worth just remembering is that we have at the moment inverted yield curve, and inverted yield curves tends to signal a problem. This was a slide I showed the other day from Bloomberg. Pretty much every time there's an inverted yield curve, we actually get a recession. And at the moment we have an inverted yield curve in the US, not in Australia yet. But if those recessionary forces, which are driven by high interest rates and everything else, flows through, then central banks are going to have to reverse track again. And if they reverse track again, they'll have to go to lower interest rates and do more quantitative easing. So this is a cul-de-sac they've reversed into without really an exit strategy. Now, Cookie said postcode 6000. Yeah, can do postcode 6000. Should be easy. Central Perth. Okay, here we go. So there are 6,800 households, of which 1,300 are borrowing, but 5,100 are renting. There's around 4,000 properties for rent, and there's around 88% in financial stress. Of that, 33% of those with a mortgage are in stress, but 67% of those renting have rental stress, and 78% of investors have investor stress. So you can see this is an investor rental problem, and that's partly because, of course, rents have gone up quite smartly in Perth, having been laggards for quite some period of time. And as a result of that, there's pressure on investors and there's pressure on renters. And in fact, I've heard of quite a few people who've ended up being forced out of their rental property because they couldn't afford the rent rise that the landlords have imposed, because they wanted to try and actually recoup greater returns to be able to cover some of the costs of their investment property. And if you look carefully, the investment market in Perth, and indeed the property prices more generally in Perth, look to me to be becoming unglued again. So that short-term spike that we got, a very considerable momentum, may well be easing at the moment, but we'll see. In terms of prices ahead, bit of growth, 2 or 3% over 3 years, but risk of considerable fall, down 16% for houses, 1.7 versus 11 for units over 3 years. Okay. And Stripey Cat says we need Steve Van Meter back on. Yeah, I'll get Steve back on again. The whole bonds thing is just crazy. So you may have been following his his daily posts on the bond thing. But I will get him on relatively soon because I think it'll be an interesting conversation. But of course, there's so many things going on internationally as well, and the gold issue relating to the Russian currency, the ruble, and how that plays into bonds is also pretty interesting too. So a lot of different moving parts. Yep, that's worse than Docklands. It is, as you say, it is. And that's quite significant, isn't it? Okay, 4132 was another one that people wanted. Do that. Okay, 4132, Crestmead and Marsden. 8,400 households, 3,300 borrowing, 4,800 renting, 3,700 properties for rent, and the financial stress is 76%. Break that out. Homeowners, 63% in mortgage stress, more than 2,000. The rental stress is at 76%, 3,600. And the investor stress is at 38%, 538, sorry, extra decimal point there. And in terms of profiles, we're looking at about 5% rise in prices for houses over the next couple of years, 3 years, or a fall of 13%, somewhere in that band there. And for units, somewhere between 3 bullish and 10 down bearish. Short answer for that question there, Ravage, is no, I don't have a gold Aussie property chart to hand. I have built one previously. I might do it again. This is an interesting comparison, isn't it, as to how those two things are moving. Of course, gold prices generally have tracked relatively sideways. Of course, they're slightly stronger now, but haven't shot away like many people who are gold bugs. I remember people talking to me about 2,000, 3,000, 5,000 for gold. Well, 1,920 or whatever is the current one. Okay, Julie asked for 4350. A lot of interesting Queensland postcodes. Interesting, isn't it? So Megan coming on next week is good timing. We'll be able to talk about all of the property stuff in Queensland. So 47,000 in this particular postcode. It's a big postcode. It includes Toowoomba and all of those areas. Remember that I did highlight the fact that there was a lot of stress here. 47,000 households, 15,000 borrowing, 23,000 renting, 17,000 properties for rent, and 47% in financial stress overall. For homeowners, 9,300 in mortgage stress. 60% is the percentage-wise, 3% of defaults. For rentals, 43% of those renting, or more than 10,000, are in rental stress, and the investor stress is sitting at about 28%. And in terms of the projections for the next 3 years, about 6.6% bullish for houses, down about 11% bearish for houses. Units up about 5%, or down about 8.5% for units over the next 3 years. So Cookie Boy said, say hello, Tony LaCantro, and plug his next live show. Yeah, so Tony's on in 2 weeks. Tony's coming back the week after next. So I look forward to that. Always worth having him on with his bingo card and all the rest of it. But look, it's playing out very much like he said. So it'll be an interesting conversation to have with him and to see what's going on. So many things, of course, are uncertain at the moment, and one of the things that he was very clear about earlier on is that people have backed themselves into a corner, and that it's going to be tough to get out. And I think the more I see the numbers and the stress levels rising, the more I think this is going to be a significant problem. Now, William asked a question about the mortgages have gone through a process of reselling from interest only to principal interest. So that's been an interesting journey, right? So 3 or 4 years ago, there was a significant drift. Something like 20% of mortgages drifted from interest only to principal interest. And then through COVID, the reverse happened. So some of the banks encouraged some people to go back and go interest only. Not dramatically, something like about 5%. So we're still about 15% lower than where we were. And in fact, the number of new interest-only loans are significantly lower. They at one stage got to, I think, 46% of all new loans being written. It's much lower today. It's closer to about 15 to 18%, I think. So that's what we're looking at. But interestingly, quite a few people who have interest-only loans are people who are highly leveraged. And the reason they went interest-only is because they couldn't afford principal interest. But of course, the thing about interest-only loans is you don't pay back the capital. And so you're banking on the future expectation of price growth. Now, we've been lucky, or not, depending on how you look at it, over the last year or so. What happens if prices go backwards from this point now? They could have this massive debt hanging. And so at some point, my expectation is the regulators will start breathing down the banks, on the banks again and say, those interest-only loans, you need a plan to get them back to principal interest. So watch this space. $6,401. I've been asked for 6401. 6401. Okay. Now, well, where does that go? There we go. There we are. Yep. Okay, so this is a relatively small postcode, 3,600 households, 1,100 borrowing, 1,700 renting, and there's about 1,300 properties for rent. Overall financial stress 42. Mortgage stress is at 40% with 472, but the default rate's very high at 6%. That's one of the highest that I've seen. And the rental stress is at 45%, and the investor stress at 29%. In terms of property growth, 5% bullish over 3 years for houses, or down 13, and 3.7% bullish, or down 9.8% for units over the next 3 years is what I'm seeing in my modelling at the moment. So there you go. How are we doing? Are the bond markets in a bubble? Could you please embase? Okay, so remember the thing about bonds is the price and the yield goes in reverse direction, right? So there's been heavy selling of bonds, and that's because people think that the value in bonds has definitely dissipated because of this interest rate move. As a result of that, price is down, yields are up. And the yields are up, meaning that it's an indication of forward interest rates. Now, the point, of course, is also that the inversion suggests that short-term rates are higher than long-term rates. So in other words, the markets are saying, we don't think that the long-term prospects in terms of the momentum in the market are as strong as you might think. Because normally you'd have a higher yield for longer term because you're tying up your money for longer, so you need to be rewarded more. But what they're actually saying now at the moment is in the long term, rates will be down again. So this is a sort of a proxy for a trajectory of rates. Now, it's not an accurate one, but it's an indication of the point in time. But it is very interesting that we've got this bit of spike. So the bond market is saying, sure, short-term rates are going up, but we don't think they'll be sustainable. We think the recession's coming. And as I showed you on to show you again, this chart highlights the fact that when you get inversion, you tend to get recession. And if you get a recession, the first thing they do is to cut rates again. So that's the sort of the mechanism that we're looking at. This is from Tony Lacandro. My first donation in Hungarian florins. Thank you very much. $8 in Oz. They've backed into a big corner here. See you all on the 19th, guys. Good night, everyone. Thanks, Tony. Great to see you. And thanks very much for the super chat. I love it. I think that's the first time I've had Hungarian florins. So thank you. Excellent. I'll take it in any currency. It's all good. Nigel says, what's happening in the Northern Territory? Well, yeah, it's very small numbers, of course, in the Northern Territory, so sometimes it's a bit difficult to get a good read. But what I can do is, let me go back to my map briefly. And let me go back to, let me just load this up. All right, so this is now looking at from Darwin, and you can see there that the overall levels of stress are relatively low, but of course it's such a low population base that it really doesn't necessarily tell you very much when you actually look at it. So superficially, not much to see here, right? And of course, prices have been quite strong for quite some period of time. But then, if you actually turn it around and say, "Well, okay, then, well, let's look at postcode 800." What's the story? So there's 3,600 households in postcode 800, and of those, 500 are borrowing, a lot of renting. So there's a lot of properties for rent. Total financial stress is 25%. That's pretty low. The mortgage stress is not great, 50%, but it's a very low number, right? Because there aren't many people borrowing. Rental stress is quite low. Investor stress is where some of the issues are because some of the returns aren't there. Property prices have been a bit iffy, of course, until quite recently they've been quite strong. But interesting, of course, is there is still potentially some growth prospect of 7 or 8% over 3 years for houses, maybe down to a bit, down 11% over 3 years. For units, up by 5 or down by 7 or 8 over the next 3 years. So that's my take there. And thank you for the super chat, Michael and Rachel. Postcode 3802. Happy to oblige. 3802. Endeavour Hills. Okay, 3802. 8,500 households, 4,000 borrowing, 2,300 renting, 2,900 property owners of rental property in the area. Overall financial stress 71%. Mortgage stress is very high, 96%. So a lot of people are struggling with those mortgages in that area. Rental stress is at 55%. And investor stress is at 24%. So there's a little bit of trouble. That's why the financial stress is so high, because, of course, all areas are registering stress levels. And as a result of that, houses over the next 3 years, very little growth on my bullish case, or a fall of up to 15% on my bearish case. Units, very small rise, or a fall of about 12% is what I'm seeing there. So not a flash area in terms of prospects, and some of these numbers being so high are quite concerning. We'll talk at the end of the show about what people should do if they actually feel that they've got rental stress, because it's a very important passing message for me to try and help people as well. So I hope that's is of some use. What else have we got? Craigieburn 3164. This is from Samir. Thank you very much for that. Let me put this number in for you. 3164. Yeah, that's interesting. Craigieburn. Is that the right postcode? Well, I can't seem to find that one. Sorry, I'm not quite sure why. 3164. I wonder if that's right. I've tried searching the postcode and I can't seem to find that. AIG. Burn 3064. There you go. That was a bit of a trap. We got there. Okay, Craigieburn. 23,000 households, 15,000 borrowing, 8,000 renting, 6,000 for rent, 60% in financial stress. For mild stress, 7,500 at 49%. Defaults at about 3%. The rental stress is at 70%. And the investor stress at 17%. So this is all about rental stress. Projections, 4% growth, bullish case over the next 3 years. Bearish, down 14.5%. Units, bullish at 3.2% over 3 years. Bearish, down 10.8% over the next 3 years. So there you go. And we got there. And thank you very much for the correction, and also to Yogi Bear, who also said, I think it's 3064. It is. I can search by location as well, but I have to type the name right, and I misread it as well, which didn't help. It's like a lot of things. It's easy when you know how. Okay, 2480 was one that people asked me for. Now, just to explain, it's close up to 9:30 at the moment. I will just go on a little bit longer because I know people quite like these postcodes, and I'm happy just to mess around them for a bit longer. But I will close out the rest of the show, and then I will come back if there are any more postcodes you'd like me to explore, just so that if people want to leave on time, they can do that without running over. Okay, so this is 2480, and we've got 19,700 households, 6,900 borrowing, 8,400 renting, 6,300 properties for rent. That's 34% in financial stress. We've got 10% in mortgage stress. We've got 48% or 4,000 in rental stress, and 35% or just over 2,000 investor stress. So that's pretty much little pockets there. Mortgage stress, the least worrying. Price growth, 5% over the next 3 years, bullish. Down 30% bearish for houses, and for units, up 3%, down about 10% is what I'm seeing there. And Cookie Boy makes a very interesting point, which I'll just come on to. People are forgetting recent high fuel prices are the equivalent to a few rate rises. Yeah, you're quite right. So the point is, of course, and this is why my approach to mortgage stress is very different from everybody else's who just look at the proportion of income going on the mortgage, right? I look at the total flow of money in, money out. Because if you've got more money going on petrol or food or other things or childcare, you've got less money, and that means that you're going to be under more pressure. So I look at it holistically. And I have great difficulty explaining to the journalists who get this fixated 30% in their heads. No, this is about cash flow. So, but it is important to understand. Steve, good night to you. Thank you very much. And Public Melody says thank you. Yeah, very good. What about poor old Mossman, says Zach. 2088. I'll do that one, and then I'll close the show formally, and then just do a few more if there's more people who would like to look at more postcodes. We'll look at Mossman. Mossman's always interesting. So before I put it up, what do you think? What would you expect one of the most affluent postcodes in the country to look like? You know, would you expect them to have no stress? Well, we'll see. Let's have a look. Here we go. This is Mossman. So there are about 13,000 households, 3,800 borrowing, 6,300 renting, and there's about 4,800 properties for rent. 50% financial stress, so about half. 25% in mortgage stress, so it's not a dramatic number because not that many people are borrowing, but 377. are in mild stress, but look at this, 577 in severe stress. That means they've got big cash flow issues. Default rates, 5%, quite high. 54% of those renting have difficulties, 3,400. 56% of investors have issues. That's more than 2,200. So put it all together, and about half of the households in this postcode have cash flow issues of various sorts. Now, I know that they've got, lots of other assets and things, so they're not going to fall over tonight, but it just shows you that they've got issues. And in terms of cash flow, in terms of projections, 3.4% bullish or 14.5% bearish for houses, up 2.6 for units or down 10.4 for units over the next 3 years. And just a quick acknowledgement of a couple of super chats. Thank you very much for that one. I really appreciate it. And also, Jeff, thank you very much. Appreciate that as well. Really appreciate those who essentially help support what we do here. We don't do this for profit. We do this because we think it's a really important conversation. So thank you very much for all of those super chats. And now let me just sort of come back and close the show, as it were, and then we can do a few more postcodes if people want to hang around. So just in terms of, as I do that, let me just make the point here that if you want more information about what we do here, go to walktheworld.com.au. There's a lot of information there, including our Walk the World funds in conjunction with Nucleus Wealth. You can get information from our blog, a Digital Financial Analytics blog, where you can subscribe and get to all alerts from everything we do. We can also get into Patreon. You can support my work, and you can get access to all of the data I've shown to light for every postcode pretty much across the country, more than 2,000 postcodes. It's a particular stress subscription, and it's $50 US a month, including in GST. Go to Patreon, sign up. You'll get access then to the history as well as the current, and as well as individual postcodes. You can compare and contrast across different postcodes, look at some of the projections, and download the entire postcode set so that you can do your own modelling. And every month from the portal, you can grab the whole data set, which is pretty powerful. So that's that. Also, if you want to make a contribution to help us, you can make a one-off contribution via PayPal. There's a link there, and thanks for those who do that. It all helps, or even Bitcoin. I'll take. I'm not proud. I'll take it anyway. Anything that's to help cover the cost of doing what we do here. And there's also the Merc store if you want to buy some Mercs. Now, just in terms of next week, Megan Wells is on to talk about Brisbane property. Very, very timely given everything that's going on there. And so that'll be worth watching. And in fact, particularly those in and around Brisbane, if you've got questions for her, then we can go into some detail there. So that's that. And just before I go, I want to highlight 4 things about mortgage stress. Most households who are in mortgage stress or rental stress or investor stress don't realise they've got a problem because they don't have enough information about their cash flows. They don't run money in, money out. So the first thing is I'd recommend everybody get to know your cash flows. Understand money in, money out. If you want some tools, the ASIC Money Smart website has some very good tools for budgeting. Second, once you've done that, you can then prioritise and see where the money is going, and maybe there's some things you can turn off and prioritise differently. Look at high interest liabilities too, because those are the things that actually will be very significant, and get rid of those first if you possibly can. That includes the credit card if you're revolving credit cards. If you have a mortgage and you've got issues, the lenders are required to deal with you fairly. And it means that if you have an issue, talk to them, because under their hardship schemes, they have an obligation to try and help. Now, sometimes they're unable to help because it's too far gone. The sooner you talk to them, the more likely you are to be able to actually deal with it. Don't just put your head in the sand and assume that somehow magic's going to fix itself. I don't see income growth going to drive very fast. Cost of living will continue to rise. So it's really important to take those early steps and tackle it early. And then finally, what I'd say is when you've prioritised and thought about what you're actually spending your funds on, not everything is equally important. Maybe you've got to give a few things up for a period of time, because this is about discipline more than anything else. And what I find in my surveys, a lot of people who've got these stress concerns, and by the way, these stress concerns can really manifest themselves in physical ways, that people get ill and all those things too, or violence, all those things follow. So there are social consequences of this sort of stress. So it's really important to tackle it early. And point one is you've got to recognize it. So if you think you have an issue, go through some of those processes and reach out, get some advice. There are financial counsellors. Go for the free ones that are actually provided by the states and territories. Don't go for those that offer to solve your debt problem by charging you an arm and a leg. There's a lot of those about. They are disgrace. They should not be there, but they are there. But be careful about that. But nevertheless, it's important to sort of tackle it early and tackle it right. So there you go. Hope that is a useful little thought in terms of how to deal with it. It's not rocket science. This is just money in, money out. How much money is coming in? How much money is going out? Prioritize, select. And also make the point, if you are a new borrower going into the market now, do your own calculations on a rate rise of 3%. Can you still afford it? Because you've got to assume that rates are going up. 3% or thereabouts. Okay, so there you go. A lot of people leaving, so thanks for that, and thanks for being with us for the show. See you next week. A lot of good comments there. Thank you very much, folks. Really appreciate that. And this is one from edited 3 months ago. Great title for for a handle. Esperance 6450. Let me put that in the system. Six, 450. Okay, Esperance. Yep, we're there. So 6,300 households, 1,800 borrowing, 3,200 renting, and the number of rental properties about 1,800. 33% in financial stress. Mortgage stress is pretty high over there. 1895, which is the same as the number of borrowing, so that's a bit of a worry. Not quite sure why that's the case, but there's some issues. Maybe that's to do with the COVID lockdowns and things, I don't know. Default's pretty high. Rental stress doesn't really appear, but the investor stress is a bit there. But look, this is it. This is about mortgage stress. I think that's probably a function of recent price rises and incomes and all those things, as well as costs. In terms of price rises, 5% bullish for houses, down 13% bearish over 3 years. Or for units, there aren't that many units, but for those that are, 3.7% bullish, or about 9.6% bearish. There you go. Hope that's of some use. Cookie boy. His joke about the 31st. One day, Cookie, I'll call your bluff and force you to do a show. That'll be fun, won't it? Okay, one more here. 2200. Whoops. Just knocked me with the mouse. Okay, putting it in now. Loading it up. Bankston. Okay, so this is 14,800 households, 4,600 borrowing, 7,800 renting, and about 5,900 properties for rent. 61% in financial stress, 34% in mortgage stress, 1,300, 2% in defaults, 68% in rental stress. So this is a rental stress story, and 47% in investor stress as well, more than 2,000. In terms of projections, 2.9% up over the next 3 years, or down 15% over the next 3 years. Units up 2%, down about 10% over the next 3 years. Okay. Ballarat Evil, Hackenham, South Australia. Greetings to South Australians, one and all. Okay, there you go. Get rid of that. And this is 5,900 households, 3,000 borrowing, 2,200 renting, 2,300 rental property owners, which is interesting, 25% in financial stress, 24% in rental in mortgage stress, 737. Default rate's about 3%. 17% in rental stress, 16% in investor stress. And in terms of projections, 10% up over the next 3 years for houses, or down about 8%. For units, up 7% over 3 years, down about 6%, bearish over 3 years. Okay, I'm going to do 2 more. This is from Rod. Nelson's Bay, 2315. Yep, Nelson Bay. Got that. Yep. Okay, get your screen there. 9340 is the number of households, 1,798 borrowing, 5,400 renting. A lot of renters. And 61% in financial stress. 67% in mortgage stress, 1,199. 3,700 in rental stress at 69%. And 39% or 726 in investor stress, with just a few in severe stress. Price rises, 1.8 over 3 years bullish, down 16% bearish for houses, 1.4% bullish for units, or down 12.2% bearish for units. There you go. Okay. Hazard, Leichhardt, 3516. Okay, 3516. Yes, very low numbers, so just be careful with this. This may not be very accurate because of the low numbers. Where we have very small counts, of course, because we gross up from a 0.5% sample, the error rates are quite big. 18% in financial stress, 2% in default rate, but no mortgage stress. A bit of rental stress, and projections up 7.8% over 3 years, or down 10% bearish case for houses, up 5.67% bullish for units, or down 7.9% bearish. There we go. Thanks, Taffy. Yes. Yeah, don't disagree with that. Thank you very much. Cookie says 30th of February next year, and let's call it a deal. Yeah, very good. Nigel says thanks for all you do. Appreciate that too. I'm running out of smoke. Stripe, I'm going to do one of yours, and then I'm going to probably call it a day there. What I will say though is, if you want a particular postcode, and I didn't cover it, if you send me a message, go to the DFA blog and send me a message, over the next few days, I'll pull out the postcode and send you the snapshot of the screen so that you can deal with it, and hopefully I can give you some information individually I can't do it on the show here, because obviously I can't go on all night doing this. I ran out of smoke myself. This is Cranbourne, 3977, and you may remember that I spoke about Cranbourne as being one of those high-stressed areas. 50% in financial stress, 32,000 households, 21,600 borrowing, 10,500 renting, 50% in financial stress. Mortgage stress is at 34%, 6,800. The rental stress is 64%, it's 6,700. And the investor stress is at 2,028%, of which 998 are severely stressed. So investors and renters are part of the problem here. And 4.6% bullish for houses over 3 years, or bearish down 13.5%. Units bullish 3.4% over 3 years, or bearish down 10% over 3 years. And Mortgage Stress Central said Stripey Cat. Yeah, exactly right. You're welcome, Ballarat Evil. 2590. 2590. Okay. 2590, 3,400 households, 1,000 borrowing, 1,300 renting, financial stress at 53%, mortgage stress at 60%, 604, rental stress 75% at more than 1,000, and overall investor stress at 20%. Projections, best bullish for houses 2.6 or bearish 15.5. For units, bullish 2%, bearish 11.6 down. Okay, and I'm afraid that's it. I've run out of smoke. So I want to say thank you all very much for spending so much time with me tonight. And we're at 9:46, so that's quite a long show. Like I say, if you have a specific postcode request, then you can contact me via the DFA blog. Go and use the little app, send me a message, ask me for a postcode, and I will, over the next few days, can't do it all at once, I will send you the screenshot of the particular postcode. So that's one way of doing it. Or indeed, you can always join me next month for another conversation about stress, or indeed subscribe via Patreon and then get all of the data for all of the postcodes, and you can do your own show as well. But anyway, I want to say thank you very much for spending so long with me tonight, and I hope that you found that useful. This is a really important topic. We'll definitely come back to it again. I think we will definitely do this monthly at the moment because this is such an important topic. And of course, the beauty of this is that every time I do it, it's based on updated information. And so this is probably the most current and up-to-date snapshot of what's going on, because of course the RBA is using data from 3 years ago because they use the information from the Melbourne Institute, and that is not up to date. And full on live stream, a lot of information, limited time, absolutely I agree, but hopefully they found that useful. And I always enjoy doing this as well, so I want to say thank you very much. So I will say thanks, have a good evening, see you next week, catch up on the recorded shows during the week, and keep watching. And if you're in mortgage stress, do something about it. Don't just hope, because hope is not a strategy. This is Marty North from Digital Finance Analytics, signing off. We'll see you next time. Cheerio.